Welcome to the live stream. We are starting 1 hour later than typical. I am joined by Daryl. How you doing this morning, Daryl?
I'm doing fantastic, Victor. It's good to be here. Hello,
It
everyone.
it is good to be here. We're coming off of a 3 day weekend, so to speak, because we didn't trade on Friday. I hope that you enjoyed a nice 3 day weekend. If you celebrate Easter, I hope you had a very nice Easter. I certainly did. I got together with family and there was some little kids involved. So it's always fun to celebrate those days when little kids get to hunt for eggs. And it was just a good time overall. So now I'm back to invest in stocks, to look at stocks from a fundamental perspective, and then listen to Daryl take a look at the technicals, which is very interesting. We had a couple stocks in mind. We're going to get into a little bit of Intuit, INTU. We're going to get into some real estate stocks. Real estate stocks did quite well last week, and we'll take a peek. We're going to look at ADC, NNN, which is triple net, and then Realty Income, which is symbol O. Now, if you have a stock you want to take a look at, you are welcome to put it in the chat. If you're a member, it comes with your membership. I appreciate your support. If you're not a member, no big deal. Just pay a $5 super chat and we are off to the races. We will analyze stocks from a fundamental perspective as well as technicals, kind of taking a look at it. And what's cool about our new start time and what I hope to do with live streams now is kind of do these streams while the market is open because, I already looked at my portfolio. I transacted a couple of sells that I had already planned out. And I'm thinking of buying a couple of other stocks, buying some shares. Well, I imagine, you might want to kind of see somebody else's research on it. We never provide financial advice, but I'm sure you want to look at research, maybe cross your T's and dot your I's. Well, it's perfect. On this live stream, you can put that stock in the chat. We will beat it up. We will take a look at it and we will conclude our research with, does it look like a good investing idea or not? Are there some big threats that maybe you hadn't thought of, or maybe you did think of them? And all things have been considered on your part and makes you a better investor. So think about that. For now, let's take a look at the market. We've got a market that's going higher, which is interesting because we've got a conflict in the Middle East, and that's driven oil prices higher. Oil prices are higher, and oil companies are going to make more money. I look forward to hearing from Exxon and Chevron I'm going to say in about 2-3 weeks' time when they announce their earnings. And they will tell us how much more money they made here in March, because in March we had oil prices go from roughly $60 per barrel up to $100. Well, that's about a 70% increase in the per barrel price. And those companies, that's going to increase their top line revenue. It's going to increase their profitability. It's going to increase free cash flows, and it will likely increase the dividends it will pay. That is sweet, sweet music to those that own oil stocks. So oil stocks are having a good day, and so's a lot of the rest of the market. We've got the Dow is up a tiny bit. The S&P is up 0.36%. The NASDAQ is rolling higher, 0.62. The Russell's up a little bit. Now, here's something interesting, Darryl. I'd like you to weigh in on this. So we see green numbers and the VIX is higher. Well, can you explain any of that?
Well, let's take a look at the VIX real quick. It's lower than it was.
Uh-huh.
So we did uh, towards the end of March, so only a week or so ago, we were above 30. So it is moving back higher, but it is below this 20-day period average, which it
Uh-huh.
had pretty much been trading above. So even though it's a bit higher today, it's down from the peak, which is we hadn't seen levels at that since the day after the tariff
Mm-hmm.
announcement. So while it is up a little bit, I I think people feel a bit of relief from the 31 level.
Yeah. And refresh my memory, the VIX is a calculation, kind of define the VIX.
So the VIX is calculated from the 30 days of options, so the next 30 days, and it's an annualized value. So they take the volatility for the next 30 days and annualize it, so 24% volatility over the year. But this is set by market makers. The put call ratio is, market participants. This is set by market makers, and it's their anticipation of volatility over the next 30 days.
Perfect. So in my mind, it's driven by investor behavior, trader behavior, and the I guess the good news within the VIX is that it is most recently it came down quite a bit. It's below the 20-day trend line, so that's encouraging. I imagine the story over in the Middle East, if that conflict gets resolved, we're going to see the VIX come down even further. Now, if we see escalation, like if we see things being blown up again this week, I imagine the VIX is going to go higher. That's
Yeah,
just going to
exactly.
happen.
Yep,
Yeah.
exactly.
Perfect.
I
Thank you,
am
sir.
seeing, yeah, I am seeing the 20-day start to roll over as well. So we'll
Okay.
see. And
Yeah.
we're a tweet away from this going back to 31.
Hmm. Okay. Well, I'll stay off X if that's going to help anything. All right, so we've got a market that's going higher. That's good. That's real good. And what I wanted to talk about next is going to be inflation. So let's take a look at what stocks are moving higher and lower, and then I want to have a little conversation around inflation. All right, so stocks moving higher. Amazon's having a good day. Looks like the financials are having a good day. The big banks are doing well. Visa, MasterCard doing well. Micron is heading higher. Boy, that thing's just been a rocket ship. Apple's moving higher. Got some software stocks. They're doing okay. Adobe, ServiceNow. Intuit's down. And then we've got communication services, Google, Meta, Netflix, the carriers. Look at that. Nice green day. Consumer staples, we've got some winners there. We got Walmart going higher. Look at that. Target. You remember I brought up Target, that
Yep.
crazy idea I had 4 or 5 months ago? Well, that crazy idea has been profitable to this point. I think I'm up nicely about 20, 22%. Pays a nice
Excellent.
dividend too. So that's a good one. All right. The energy complex, man, if you're going to give me a discount on energy stocks, I will take it. I will also say thank you. Got to be polite. So Oxy's down a little bit. I'm willing to pick up some shares there. Oil stocks right now, they're my insurance policy. If this situation in the Middle East gets uglier, because it's already ugly, these stocks are going to flourish. You know, I don't want these stocks to flourish. I don't want them to flourish. I want these stocks to struggle. So all these other stocks that I own do great. We don't have a war. People don't get hurt. They don't, infrastructure doesn't get blown up and so forth. But if the conflict gets ugly, this sector is going to flourish. So that's my insurance, is this will limit my losses across all other sectors. So that's why on down days, I will pick up more shares of Chevron. I'll pick up more shares of Oxy, Canadian Natural Resources, SLB, and Hafnia. Hafnia is probably going to make some big money transporting all that oil around the world. Now, I talked about real estate, and the reason I want to look at real estate is look at this. We got some real estate stocks moving higher. And I think that last week, this thing was just a bright green.
Yeah,
You
real
noticed it.
estate was the best performing sector last week.
That's my point is, I want to take a look at real estate. I own one real estate stock and I also own real estate that I rent out to people, but I wanted to see if maybe I can increase my allocation into real estate by one stock. So we'll do some homework there today and hopefully you guys find it interesting. So that's where we're at there. Now let's talk a little inflation. So crude oil prices are higher, right? And how will that impact inflation? And Any thoughts there that you have?
Well, the Fed normally uses the core measurements, and that excludes food and energy because they
Mhm.
tend to be volatile. So they prefer the core measurements of inflation, whether it's PPI or CPI, which we'll get a reading on that this Friday. But they like to exclude oil or energy and food.
Okay. And they exclude it, but unfortunately, the consumer, if you recall, remember we were paying like $8 for a dozen eggs
I remember them going up. Yep, when
in
we had the bird
2022.
flu. Yep.
Let me tell you, my mom, who's 90 now, and I guess at that time, what was she, about 90, 86? She became an instant economist and an instant egg trader, and she's a wonderful lady. So she started to kind of know her market, and she was finding the best priced eggs, and she would buy literally like 10 dozen and then get on the phone. And of course, she gave me the instructions. You come here and you're going to pick up the eggs, and you're going to take 2 dozen of so and so and 2 dozen of so and so, and you're going to keep 2 dozen. And I'm like, all right, mom. So eggs got really expensive. So the consumer, people like my mom, who frankly has never bought one stock in her life, she's bought real estate. She's obviously buying eggs. It makes everybody a quick economist. They begin to change their behavior. And gasoline's the same thing. I imagine EVs are going to start to sell a little better, right? Because you got in California, it's a great place to live. Let me tell you, this winter, I feel bad for everybody in the Northeast. And during those really bad winter storms, we were at like 75 to 85 degrees. And it's like, geez, it is ridiculous out here. But that's why everybody's out here. And that's why the state charges really high taxes on everything, including fuel. So our gasoline is hitting. I heard one story that somebody got to a gas station was paying $7 a gallon. Woohoo. I've been paying close to $6 a gallon, but I also own an EV. Guess what I'm driving most often these days? That EV. That EV is getting a lot of miles, and I think others will do the same. Now, one thing I wanted to come around to is inflation. Oil will impact inflation because the input costs, as an example, Amazon announced that there's going to be a 3% surcharge on deliveries to cover the increased oil. So everybody buys, geez, I buy so much stuff. My family, I should say, we buy so much stuff from Amazon, from simple products to, you know, uh, some essentials. It just seems like we're getting a couple deliveries a week, and I'm sure everybody feels the same way. And that 3%, that's 3%. The Amazon does over $600 billion annual revenue. 3% on that is $18 billion of a new cost. And it's not that the product got 3% bigger. It's not that the product got 3% better. It's because they have to pay a lot more for gasoline and diesel. So they're going to charge us 3% more. And I think that's going to be the case in other categories. So it should move that inflation higher. It's just common sense. And it will change consumer behavior. I think consumer behavior will change if we have elevated oil prices. Now, one thing I've noticed about oil prices, 2008, of course, we remember it because we had the subprime mortgage meltdown, which created just a big problem for that debt. And if you watch the movie The Big Short, that's what it's about. It's about how collateralized debt instruments were being uh, created in a way that was fraudulent, and a lot of investors lost a lot of money. That did create a huge stock market crash. But look at that. Oil was also peaking at the same time. So there was a double punch there. It was like a combination from Mike Tyson in his prime, and it led to a horrible S&P performance going down 37%. But let's fast forward to 2018. We had elevated oil prices and we had a nice correction of 4%. More recently, 2022, Ukraine war. Well, that created some higher oil prices because Russia's a big producer of oil, and once they invaded Ukraine, it was there was a trade embargo, some type of a restriction on Russian oil. When you took that off the market, it elevated oil prices, and it created a situation where a combination of we have high oil prices and we had high stock prices, but there it is, high oil prices, market comes to back down, and and now we're dealing with a peak in oil prices. And so far, the S&P, and I did this yesterday, so I know that the S&P is up a little bit today. It's down 4%. And what I'm going to say is, I can't predict the future, can't do that at all, but I could pretty much expect that if we stay above $100 per barrel for like the next 7 months, there's no way I could expect the stock market to go higher. I would expect the stock market's going to go 10, 15% lower. That's my expectation. I could be wrong, but I'm just looking at it from a common sense perspective. High oil, it's high oil. We all have to pay it. Businesses have to pay it. Whether you're Union Pacific that puts a bunch of diesel in their trains and moves freight from one place to another. If you're moving a container ship from China to the west coast of the US, you're putting a bunch of, they call it heavy crude, or forgot what they call their oil. And just everywhere, it's everywhere. Products, plastics, all that kind of stuff. The input cost is going to go up. So that's one of the things that I'm keeping an eye on, because I think it's the number one variable that's going to impact 2026, obviously, right? For the last, call it 40 days, this has been the story. This has been the impact. And the longer we stay in this elevated oil price market, the more it's going to be a bad market, or not a bad market, but stock prices for growth stocks will decline, and investors will really appreciate the oil stocks, the real estate stocks, the safety stocks, the consumer staple stocks. So any last thoughts on oil prices and inflation, Daryl?
Nope, you pretty much nailed it, man.
All right, so let's move on. Looks like we've got Anderson. Good to see you. How are you? I'm doing great, man. I am doing great. Good to see you. Thanks for showing up. And Ben 10, great to see you. I'm doing well. I had a nice Easter, by the way, Anderson. I hope you did the same. Man, the food was good yesterday. Kurt, good to see you, Kurt. Daryl, can you expand a bit on United Healthcare outlook? Look at that. All right. So we got a request to look at UNH, if you want to queue that up. And we can handle it now or later. You tell me when, but we're going to handle United Healthcare for our friend Kurt.
Yeah, I can do it right now.
All right. Look at that. Look at that.
I'm going to give the abbreviated version because I put out my weekly chart review and trade decisions on yesterday. And I explained the high level thinking on UNH, and it basically tied to what Victor was just saying. This is somewhat of a safety stock, and I think the risk to reward is set up okay right now. So we're looking at the 1.5 years worth of data. We can see all the bad news, couple pieces of good news in blue, couple more pieces of bad news in red here. And one of the things I'll be keeping an eye on, and the reason I'm keeping my position somewhat light at the moment, is this medical care ratio, which one is one of their primary metrics, and it was at 89.1% during their last earnings. That was about 340 basis points above the previous year. So what I'm thinking right now is they're trading at 282 right now. They're up 1.93%. They were up about 7% last week. That would put them down. It was when I did my videos this week, it was 18%. It's getting closer to 19% away now. Look to the far left of my screen, and I just drug down from that higher price to the low, 52-week low, and it's down 18.72%. If you can see it on the far left side of my screen. Okay, so we've got about 18% down. I think that they can recover back to pricing that we saw back in October and November, providing they can, through their AI initiatives and working on this ratio, if they can get that back down, 3% or so, then they'll be back up to these prices. But if we do the same activity that we just did, then we've got about a 37% upside. So that's a 2-to-1 ratio from the low back up to these levels that we saw in September and October. I don't think we're going back down to these lows. We've got two really good support levels here that are between about 260 and 270 or so. That's only about 3 to 6.5% downside with a 37% upside. They're paying a dividend yield of 3.13, which is much higher than is typical for them, their 5-year average. So I don't have, this isn't going to be a Google type returns that I'm expecting. But I think in a year like we're talking, so we're talking high oil prices, healthcare, I don't think uses a whole lot of oil, directly anyway. We have the midterm election year. I went over the seasonality data in both videos, one comparing UNH to the SPY, and in the video I did yesterday, I just looked at the SPY. So anyway, I think given the midterm elections, oil, and the potential for inflation, to me, this looks like a good setup. The risk reward is nice. They still have their issues that they have to work through, but this is to me, a comfortable stock to sit in if you're expecting a lot of volatility over the next 6 months, which I am. So that's why I decided to go ahead and get back into it. And I'm adding very slowly. I want to get to their first quarter report. That's going to be critical. And then if they do well there, then I'll start adding back to what I want portfolio weight wise in my portfolio. I'm not expecting them to go back to their all-time highs, but this level right here, I think, is pretty reasonable. So hopefully that helps, Kurt. If you want more details, look at my 2 videos that I did over the weekend. So I spent about 36 minutes on UNH alone in that one video.
So Anderson is saying that he really appreciated the video. Great work. Excellent work. I
Thank
need to
you.
see that video, by the way. I saw your other video, but not this one.
Yeah, thank you, Anderson.
Nice work there. So I did it. Now, this is not a political channel. You guys know that. So, but I wanted from, hey, how's it going to affect stocks and how's it going to affect UNH? But what are the top like midterm election political topics? The affordability crisis and healthcare costs. Okay. So That's going to be talked about quite a bit, and United Healthcare will have to show how they're going to fit into that. Um, and we'll see what happens there. All right. So one thing I wanted to show is United Health. I am a holder of United Health stock. I feel fine with the stock. This thing's going to do well over time. The unemployment came out, I think it was Friday when we had the day off. So not a lot of people are aware of it, but the unemployment came out and it was actually a positive report. The jobs created number was better than expected. It was a good number. The number one category, healthcare. There were jobs created in healthcare. And to me, that shows that healthcare is going to be necessary, needed, whether the economy's good, the economy's bad, we're in a war, we're not in a war, we got high oil, we got low oil. It doesn't matter. We go to the doctor. If we have a need from a healthcare perspective, we go take care of that need. So that's kind of a pretty good resilient model. So I'm hoping that United Health, they certainly had a couple rough years, will begin to construct a really nice gain for investors. I like the stock. I think the company's well run. I think we'll see how it goes. We'll see how United Health goes. All right, so we
Yeah,
had
I think they're spending about 1.5 billion on AI initiatives right now. So
and let me kind of touch on that a little bit. When you think about Anthropic Claude Cowork, which is basically you're having these agents do tasks for an insurance company like United Health, this is going to reduce their cost. When you look at one of the metrics that you look at with an insurance company is their expense ratio. And if their expense ratio, and that's actually directed at the actual healthcare expense, right? Paying doctors, nurses, medicines, and all that good stuff. But the operation of United Health is going to be greatly improved by agentic AI. And it's not good news for people that work at corporate over at United Healthcare or maybe handling a bunch of jobs that, computers are going to handle in the future. And I would encourage you to. So reason I started with Claude Cowork is this is going to be the one right now. This is the leader for companies, right? Companies could either use Cowork or they can use, like if they use a big system like an Oracle or a Microsoft, you can look at those, agentic AI products. They're not as good, frankly. I'm familiar with both of them. Claude is the real deal for a corporate client. But for you and I, OpenClaw is a game changer, folks. This thing can do anything that I ask it to do on my computer. It's not running on this computer. This computer has a lot of sensitive data. You install it on a secondary computer that doesn't have sensitive data because this thing's so darn powerful. You don't want it to know your login and password to your brokerage account. You don't want it to know a bunch of sensitive data. So you put it on a secondary computer. But this thing is updating my Google Sheets. I'm going to have it do like 20 other things and it's going to free up my time. Well, it's evidence that agentic AI is super efficient. People can now have these agents working on their behalf, and it's almost like you have these coworkers that are robots. That's really how it feels. If you use OpenClaw initially, it kind of befriends you and you get to know it gets to know you. And it really does feel like a darn relationship. I'm not like a weirdo that's in love with machines, but I can tell you it's been a really, really cool experience to work with OpenClaw. And then once you get going, you get this thing going, you have it do tasks for you, and it's really magical. And that's how I would tell you, because you really do kind of you teach it almost like you're teaching another person. If you train somebody to do a job, you know that there's a little bit of trial and error involved. You tell them this is how you do the job, and then they try it and they get stuck or they do it a little bit wrong, and then you give them a little bit of feedback, and then they course correct. and maybe you go back and forth 3-4 times, and then they got it, and then they get better at it. It's exactly how OpenClaw works. So in that respect, it's very human-like, and it's super cool. And this is the fastest. This is the open source application that's grown the fastest in the history of open source because it is really a game changer. So back to our friends over at United Health. You mix in all that AI efficiency to a massive healthcare insurance company. I only expect that this company is just going to increase profits. They're still going to provide the healthcare that's, doctors, nurses, hospitals, surgeries, and so forth. We still want that, need that. But boy, these guys, AI is going to be a tailwind. AI is definitely going to be a tailwind for United Health, and we'll keep an eye on it. All right. So the chat is nice and active. We've got a lot of people on the stream. Thanks everybody for joining. Let's take a peek at this market here. What's going on, stock market? All right. Apple. What's going on in Apple land here? Up 2.39. Very nice appreciation. Looks like Google's rising nicely. I'll take it. Looks like financials. Look at that. I think, are you in Citi?
Yes, I am.
All right. Well, there you go.
I think they're going to probably perform best of the big banks this year.
I have felt that way for 3 years. I used to be a JP Morgan guy and held JP Morgan for years. Glad I did so. JP Morgan's just been a winning recipe. And then I kept looking at Citi. Citi looks so darn valuable. I switched horses. I'm going to say about 3 years ago. And I'm glad. That is one of the changes because I had like $100,000 in JP Morgan. And I switched to Citibank. And at times it felt like, oh man, maybe I made a mistake. But overall, nope. That was a very good decision. And I've made some bad decisions too, which I'm willing to talk about, but this was one of the good ones. So glad I did so. All right. So Amazon's higher. All right. Very good. And you look at that. Look at that, Daryl. I guess everybody watched your video and everybody's buying into United Health. Look at that. Wow. Molina Healthcare. I think some members of our community are in Molina. So I'm glad they are like enjoying the day. Energy down. All right. You guys know what I'm going to do there. Just buying some more insurance. That's all I'm doing. I don't like paying for insurance. I pay automobile insurance, not because I want to get in an accident today, but because in case I get in an accident, things are handled. I don't want to buy the energy stocks, but I'm going to buy them in case this war gets a lot worse. And if it does, boy, that Chevron stock's going to look real good. All right. So we are rocking on the stock market. Now, somebody brought up Dave, and I brought it up actually earlier. And I noticed that Dave was doing well today, and it was a response to SoFi. Anderson was talking about SoFi. No. Somebody else did. I think it was Ben 10. Sorry. I'm getting my... See, the chat confuses me. Sorry, guys. I think it was Ben 10 brought up SoFi. I'm like, yeah, SoFi is exciting. Dave was up quite a bit. And I think Kurt's a little nervous about how this thing's been trending lower. And I see his point. This thing is a really good growth stock. If you look at their revenue growth, that looks fantastic. They have good profitability and cash flow. And if we look at their forecast, we've got 10 analysts saying, hey, this is what I think is going to happen. And they think it's going to grow by 26% this year, 17. Now, this is a new generation financial services company. And I like how they do business. These companies tend to do well because, I think that the banking industry and the financial services industry, it's the user experience, the customer experience is kind of lethargic. It's, administrative burdens and so forth. So when a new company comes out and says, "Hey, we want to give you a different experience," I think they have a chance to really be successful. Robinhood's a great example. Robinhood's come into a market and said, "Hey, zero cost trades. We're going to do this. We're going to have a UI that's really exceptional. It's very gamified, very pleasing to the user." And those things I think matter. And I think Dave, for those reasons, is an interesting stock for me. I own a tiny position. Now, I'd like to get your comments, if you wouldn't mind, on Dave and what you think the charts are looking like for this stock.
Okay, so the way we've talked about this before, maybe 5 years is too much data here. We just want to look at these breakouts. So I've put boxes around consolidation periods, and then you get the breakout, you get a consolidation, you get a breakout. I could show you NVIDIA as well. They kind of follow the same pattern. So if you can catch it on a breakout, I mean, it's just going to cycle around a price when it's in this consolidation pattern. But when you can see these breakouts start to happen, so that's basically uh, when you have an RSI that's shooting from 40 to 60 in less than a couple of days. That's something to be looking at. When you get a PPO that's shooting almost vertical like this, you can catch that just about the time that you get an RSI of 50 and you get a crossover. That would be a really good time to get in. Let's look at this breakout. Very similar thing. You were at 40, you shot up to 50, immediately crossed over 60. So you knew something was setting up. The PPO started from a negative territory, but you did get the bullish crossover there. And then you got a RSI that crossed above 50 to confirm that. So you were probably thinking you were within a short period of some kind of breakout. And then they roll over in both cases. And that's when you just start consolidating. So be on the lookout. We were at 30 just last week. Let me go into just a year. And I'm going to adjust this box just so we can see. So I'm just going to basically drag this over because we're still basically consolidating. We're not to the upper end of that box. So let me save that. And the RSI got down to 30. We're getting to a 40 right now. The PPO is, waning off. So I don't think we're set up for a breakout at the moment. But keep an eye here. Look for that RSI to get back above 50. Look for a crossover on the PPO, and hope for the best, because when these break out, it breaks out pretty solidly and does some really great things. 104% increase there. If we go back to this one and we just take kind of the middle pricing and we run it up to there, that's 127%. And then when you're inside of that box, it's still 70%, but it just kind of floats around there. Keep an eye on these PPO and RSI. And when they start setting up, then I would consider stepping in at that point. Heavy, actually.
Okay. Yeah, this is a small cap, so I'm still in the trying to form confidence in the stock. I'm glad that I own it, and it looks like it's okay to continue to own it for now, and we'll see where it goes. It's a nicely priced stock. It has a tremendous future. If it pulls off what it's trying to pull off, this thing's going to go much higher because it's going to grab a pretty good share of the market. And I would say that the incumbents don't have anything to say about it. They can't compete against them. They're not they're, you know, Dave is coming to the market with such a different experience. The other guys, they have nothing. It's like, geez, we can't compete against you. You've taken a market that was there and very fertile for you, but we don't have any way to compete against you, which is fantastic. I want businesses like that. I want them to resemble a monopoly, a legal one, but do it through innovation, which is what Dave's trying to do. All right, let's switch topics and talk about this stock pick contest. We had a winner for the first quarter. It was Genetic Smite. He picked ALM. So we have started a new quarter, and whoever comes out ahead for the second quarter from April 1st through June 30th, they will win an annual pro subscription to Stock Analysis. Thanks so much, Stock Analysis, for sponsoring the consecutive quarter. Really appreciate that. And Mr. Genetic Smite has already been awarded an annual subscription to the pro level over at Stock Analysis. Congratulations again. Now, it looks like Genetic Smite is not ready to relinquish the spot. He's still number one for the quarter. This is measured from April 1st to now. But Dwayne, he's coming on. He's saying, hey, man, I think Oscar is going to make some noise. Excellent. Oust is in third place. Nebius, BT. Now, this one is super tiny, man. These guys could either win the whole thing or be in last place, but it's not going to be in the middle, in my opinion. And it looks like they're having a decent couple of days. United Health is up there. So we'll see where things land. And good luck to you guys. Hopefully we can have some fun with it and maybe come out with a couple good ideas on something that might be a good investment for 2026. All right, let's check in with this stock market, see what's going on. We're still green. We're still green. And so what's the status on this whole, like, the war, right? There's hey, you better open up the strait or we're going to bomb you kind of notice. And that's supposed to happen tomorrow, correct?
I think so.
So why is the market going higher? Is there like a little bit of like activity where the countries involved are kind of getting together trying to figure this thing out?
That may be going on in the background for sure.
Okay. Well, I hope that's the case overall. All right. So looking at sectors, we got materials down, communications higher, energy down, industrial slightly down, financials up quite a bit. Staples are up, real estate's up, technology's higher, healthcare is a little higher, discretionary is much higher, so it looks good. Okay, and one last peek at the heat map. Then we're going to go turn our attention to a couple of stocks that have been requested. BWXT. BWXT is going to be the next stock. Ricardo is tuning in. He wanted to take a look at those. Man, financials are having a good day. It is a good day in financials. And we've got the other areas look good as well. Like the consumer discretionary. This is one area that I'm a little nervous about, especially around travel and lodging. But I could be wrong. Like things could continue to go higher. But I am nervous that how many things can come up that are negatives, a war, high oil prices, potentially higher inflation, and people keep traveling. So looks like booking's having a good day. Airbnb's having a good day. The cruise lines are having a good day. All right, cool. All right, good to see you, Alex. So Trump's having a press conference at 1 p.m., I imagine Eastern. So, okay. Everybody buckle up because the market may move at 1 shortly after 1 p.m. Eastern. So we'll see what happens. All right. So our friend Ricardo wants to look at BWXT. And this is BWX Technologies, manufactures and sells nuclear components in the United States, Canada, and internationally. The company operates through two segments: government operations and commercial operations. This is an industrial, aerospace, and defense. So they're doing nuclear components. Nuclear has made a big rebound. Look at that, 217%. Nuclear for a long time, we had the 3 Mile Island incident in the 1970s, which was a big nuclear failure in Pennsylvania, central Pennsylvania. That scared a lot of people. Of course, we had Chernobyl in Russia, or we didn't have it, but it happened. And that obviously was like a horrible situation. More recently, we had in Japan, we had an earthquake, we had a tsunami. The tsunami caused the pumps to the power generating equipment that would filter or flow water into the reactors fail, and that created an incident. So those things, create fear around nuclear. But I think the data centers are like, hey, we need nuclear. We need nuclear for these data centers. These data centers are going to use massive amounts of power, and they're willing to, work within the nuclear, establishment. Now, one thing about nuclear is like the Navy has successfully used nuclear, but I think the Navy doesn't really care how much it costs, and they're safe around it. Where industry, they do care about cost. You can't spend too much on power, because if you're spending, 5-10 times more money on nuclear versus the other methods, which are burning coal or burning natural gas or solar, wind, and so forth, it's just not going to be viable, because private companies would just buy the lower cost energy. But these guys are a $20 billion market cap company. They have a high PE, and the dividend is low. They have been growing nicely, 18% growth. Most recent quarter looks good. So the growth looks really good. And looking at this company, how's their gross? See, their gross profits, and it's a low ceiling. Their gross profits 23. Okay, and you can look at other industries where the gross profits 85, 75. That's a high ceiling. This one's a low ceiling, and they do make good profit. And a part of that is government, right? With governments, you have cost plus contracts. So you're not allowed to, hey, we're going to charge you, 80% gross margins. Nope. They're like, the good news is you're going to make money, but you're not going to make a lot of money. And that is what the industry has. The free cash flow margin is 9.23%. So these are good numbers. These are good numbers, but they're not fantastic numbers. And when we look at their forecast, the growth this year is supposed to be the best growth they've had in the 8 to 10 years I'm looking at here. And the growth is going to continue, but it's not going to be as fantastic as it's looking like this year. So this is one thing to consider: is the stock is up quite a bit, and the growth isn't going to be as exciting. The PE ratio is much higher. Now, if there's any kind of pause, slow down to the data center build out, this stock's going to get crushed. If we keep going on the data center build out, this stock's going to continue to be in demand, because the nuclear power idea continues to have a lot of support, a lot of interest. So that's what I'm expecting high level. Let me kick it over to Daryl. I'll see if I have a valuation on this stock, or we can create one.
Okay, so first thing I did was just went back 5 years, see if we could find an auto support resistance to see where they kind of quiesce around. Then I jumped back to 10 years. And from 2018 all the way to 2023, they traded within a range. But then basically, when I look at a lot of these utilities or technologies associated with this theme, you can almost bet that in September, when OpenAI was announced, you can almost bet that the stock started increasing about that time. So I knew nothing about this company 3 minutes ago, but here we are, September, October, and that's when the price started shooting up. So let's go into a year now that we know why this line is here. So they jumped up above that back. I suspect this was probably earnings. I see a dividend was paid shortly after, so I'm suspecting this is a earnings date. They were up 17%. And then they traded above that level, traded at the auto support resistance line for a month and a half. And then we had candles that generated 3 white soldiers, they call these. So you can see there are 3 candles that are not filled, means it opened higher than the previous day and closed higher on that day, higher than it opened. So you get 3 white candles. And just so I can show you, here's a whole bunch of examples of candle patterns, and here's the 3 white soldiers, and that is a bullish pattern. So not only did we see one, we had a red candle and then a black candle, and then we had 3 more white soldiers. So if you'd have bought after this one right there, then you would have been up. Oh, it's only about 7%, but still, that's a pretty strong bullish pattern there. After they reached their highs here, they've been trading sideways. We do have a 20-day that, let me go to just maybe 6 months so we can see a little better. Yeah, so the 21 day is increasing. It is above the 50-day, which had been increasing and looks to be leveling out a bit. The 200-day is still increasing, so those 3 moving averages are in the correct order. We haven't really been able to break above a 60 RSI since about the 3rd of February. We did have a break above 60 back when that first 3 white soldier pattern was created. And then we moved into an overbought condition, and we've drifted back down to the 40 line here at least a couple of times, and now we're back above 50, so it is bullish. And I notice we got a bullish crossover in bullish territory. I'm starting to see accumulation get picked back up. It's been steady, had leveled off for a while, peaked out in March, and then again at the end of March. So we're not far from not all-time highs, 6-month highs. Let me go back out to a year. Yeah, so we're not far from at least 52-week highs on accumulation. money flow is starting to move back into bullish territory as well. So it'll be interesting to see what Victor says on the fundamentals. I mean, technically, they're still looking pretty good at this point.
So I finished the valuation and the numbers. Okay, we're looking at numbers, and the numbers just don't look all that great because they have that low ceiling I was referring to earlier. So that low ceiling is going to keep their free cash flow and profits pretty much, limited. And it's just really priced way too high. If you compare the intrinsic value of the numbers, the expected free cash flow, the expected profits, and compare it to the stock price, investors are paying a very high PE ratio for an industry that has historically had a much lower PE ratio. And they're paying a higher PE ratio because the story is quite real, which is data centers require more power. There's a war going on, so these guys probably feed the military as well. So all those things are factors that are making the story that much more prosperous. I'm willing to invest in a story so long as the numbers also support the story. And right now, these numbers, I just I would not buy the stock because of the numbers, and I'll leave it up to somebody else. A lot of people have made money in aerospace and defense. Congratulations. They've made money in certain storylines that have been fantastic, and congratulations. I hope it continues to work, and we'll see where it goes. But that's my analysis on it. I added it to the watch list, and I think Ricardo, you have access to this watch list. Everybody who's an advanced member or higher has access to this watch list. And this watch list has now about 400 tickers that we've analyzed on live streams or I analyze on videos. And now I have OpenClaw helping me update the data, by the way, which is really cool. And you have access to this research. So you can go on it right now if you're an advanced member or higher, and take a look at these valuations on your own. Look at the intrinsic value. This was just added, so we just added one more stock to that list. Great to see you, Ricardo. Looks like Mike, the dividend investor guy, is on. We're going to look at BBWI next, and then we're going to look at Palantir, which was the second one that Ricardo wanted to take a look at. So let's take a look. Genetic Smite is here. Hello, sir. Good to see you. All right, so let's look at, I think it's Bath and Body Works, BBWI, Bath and Body Works. So this is a retailer. They create their own products, right? It's like their formulas, their products for women. And BBWI is not on the watch list, so we're probably gonna have to create a valuation. No problem. We can do that. And so this company is going to be a super small cap, 3.57 billion. You're paying only, half of what revenue is at. The 1 year, not very good for the 5 year. But is this going to be a stock that is priced so low that it's just going to reward investors who see that they're going to do better than what most people think? They pay a nice dividend, 4.5%. I'd like to see if they can afford that dividend as part of our research here. Now, when we look at their revenue, the revenue is kind of stabilizing. It's not going higher, but it's not going much lower either. They had a really good year in 21, but they had a horrible year in 2019. That's pre-COVID, okay? So something bad happened in 2019. And since then, they had a couple good years, followed by some bad but not terrible years. So looking at their margins, let's see what kind of money they make. And their gross margins are 44%. Profit margins look good. Free cash flow margin looks good too. So they make money. So that's very good. Okay. Now, the forecast, I wonder how they're supposed to do for the next couple of years. It looks good. So we are in the year that's going to end January 31st, 2027. And this year, it's going to be a little bit of a contracting year. And if we want to go to the quarterly, so we've got the quarter that ended January. This was the fourth quarter. They follow the retail calendar because they're a retailer. Q1 is going to be reported. So January 1st. Why are we going from January all the way to May? It should go from January to, I guess that's right. Nope. It should be at the end of April because you got, anyway, I think these months are labeled wrong. But it looks like they're going to have a couple rough quarters and then they're going to start growing. Now, what is interesting for me, I'm like, okay, this might be a pretty good investment idea, is if this happens, this stock's going to move higher. They pay a dividend. So we got to check to see if that dividend is affordable. But if they start growing and they're paying a dividend, this might be a pretty good idea. So payout ratio 25%. Okay. All right. So this is a sick puppy, but it's the type of breed that, if this puppy survives, boy, it's a real valuable puppy. And I'm not a dog expert, so I don't know what that dog would look like. All right. So I'm going to crack open a valuation, but before I do that, let me kick it over to Daryl, who could kind of take us through the charts on this one. And then I'll come back and show you the valuation.
Okay. So their payout ratio looks like their operating earnings are covering that okay. They are trading quite a bit below their fair value and their normal market multiple. So let's go look at the chart. I'm looking over 15 years here. I can see that it's pretty cyclical, and when they get on a downtrend, it lasts for years. So 2021, they've been declining. Here it started in 2015 and went all the way to COVID. So they're pretty cyclical, and the cycle looks to be pretty long. So we are maybe near a bottom of a cycle. So I don't know that. I don't really follow retailers like this. Consumer discretionary has me a bit spooked this year, so I would be careful with that. So all of the moving averages are in the wrong order. As recently as November, they took a 25% drop, and then the next day was another 5%, so 30% drop, and they're not trading much above that right now. The RSI is back down to 40. They did get down to 30. Let's see, on the 27th of March. PPO is in bearish territory. Accumulation is near a 52-week low. Money flow is negative. So I don't know about this one.
All right. So let me bring it back to my screen. I'll take you through finishing the valuation. So this is Bath and Body Works. I'm going with an 8% discount rate. They're a little riskier than, let's say, a Costco, which would be at a 7.5. I happen to think the Bath and Body Works straddles consumer staples and consumer discretionary. And the reason I say that is you have a lot of products that it's sold at a Bath and Body Works that, you know, women consume regularly. They they will buy, you know, shampoos and, you know, skin treatments and all kinds of stuff there. And if we're in a bad economy, they're going to keep going back to the store and buying their skin treatment because it's not like the most expensive store that you're going to come across. It's not like you're going to, and I'm not a cosmetics guy, but you're not going to like to the big expensive store. You're going to a store that has a lot of products that I believe don't have chemicals or try to shy away from like chemicals that could be harmful to one's body. So I happen to think this one's not as like risky as like a luxury item retailer. So that's one of the things that I would say out there. Now, I'm going to go with a just looking at their free cash flow for this year. I'm not growing it because they're supposed to be contracting a little bit. So we'll just go with the trailing 12 months. And then we're going to grow it very gradually at 4% for the years 2 through 4. I'm going to grow it in terminal value by 3.5%. Let me kick out one decimal there so we know what we're dealing with. Now let's take a look at the free cash flow that they've had for the trailing 12 months. And that amount is 860. Well, I'm sorry, the cash balance. The cash balance is 953 million. The total debt is 4,950 million. And the shares outstanding. Let's take a look at that. So 200. All right. So those numbers, the numbers have a much higher intrinsic value compared to the current stock price. The numbers, and you've seen the stock price come down, right? It's coming down because investors don't like that top line revenue going down because it shows are people going to other, retailers that retail the product, they sell to women potentially, but most definitely you don't want top line revenue contracting. You want it growing. Now, if they start growing, investors are going to flip. They're going to be like, hey, wait, these guys are going to grow. I'm interested. Let's take a look at their earnings per share. What's expected for the current year we're in, and that is $2.62. This is not a growing business. I'm going to give them a P of 10 and growth rate of I'm going to grow it at 7%. So overall, Bath and Body Works is a discounted stock. I think similar to what I was seeing with Target, I think this one's a quarter, maybe 2 away from being like perfect. If they can show a quarter where it's productive and followed up with a decent quarter, this thing should shoot up and it could go up nicely. In the meantime, you're being paid that dividend that they could afford. So this is looking like a good idea. This is going to be a closely watched, maybe buy stock in the next 3 to 6 months. That's how I would view it, because the numbers have higher value than the current stock price. What I do here in this particular model is I'm looking at numbers. If you stripped away, names and so forth, it's like if this entity could deliver this kind of cash flow and this kind of profit, where would you value it? Almost treating it like a bond. Well, this is where you would value it. Now, that's part of the decision making on a stock. Other things like what Daryl shared on the technicals, how are other investors treating the stock? Are they selling it off? Is it in a very bad trend? All those things are part of the decision making process. But qualitative decisions that you need to make on stocks, those are critical because those are going to be the difference between making a really good investment and not. And I think buying at the right time would be a good idea here. This stock is totally a Berkshire Hathaway stock. They buy stocks like these. They buy See's Candy. They buy like stocks that have these really good numbers, and the market just doesn't really like the type of business it is. So thanks for asking, Mike. Let me add this guy to the watch list. I'm going to put it in a watch buy. I'm going to put him in a watch buy here. So
I'm looking at the volume by price, and there's going to be a lot of resistance at around 28 up to 33. Most of the volume over the last 5 years has been in that range. So the chance of getting back to their intrinsic value of 56 anytime soon is pretty far away, in my opinion.
Man,
that's after they've got to get these moving averages in the right order, and they've got to get above those moving averages, and they need to start turning up. So it's going to be a challenging one technically.
Yeah, and I cannot argue. I think everything you're sharing is very rational. Everything you're saying makes total sense to me. But making money on stocks is about, at times, you take a position where you think the market's wrong. You think most investors are wrong. And on stocks like this, if you bought the stock and you, the investor, you're wrong, maybe it goes down further. But how much further can it go down? It's already down a substantial amount. So
yep.
Can only go down to zero, right? So, but put a period on that. But what if the investor is right? And 3 months from now, some of the investors begin to see it. Some other investors begin to see it. 6 months from now, more investors begin to see it. 9 months from now, everybody sees it. And you're like sitting there going, sweet, I just tripled my money. And that's investing. So this one here, don't know where the stock's going to go, but I could tell you the numbers look fantastic. I could tell you the numbers look like this stock is worth taking a look at as an investment. I'm going to put a little note here. Maybe this is a good buy stock. And again, the thing that I think that their products, let's take a look at their website real quick, and I'll make my point with some of their products that are going to be listed on here. When we look at their products, excuse me, everybody. And so when we look at their products, I wouldn't know about the candles, but like, see the skin treatments or the body washes and the shampoos. I mean, everybody takes a shower every day. Everybody wakes up and gets themselves ready, takes care of themselves. So I think they straddle consumer discretionary, consumer staples, because I know of consumer staple stocks that sell these products. So that's one thing I would point out, that and people do kind of lock in on the brands. I could tell you, like, certain shampoos, it's almost like, if I, like, when I'm traveling, especially, I think that the hotels are pretty smart about not putting shampoos and body washes that are going to cause an allergic reaction to people. But it is kind of a, hey, this isn't what I use every day kind of experience. And at home, I mean, I've been using the same shampoo. My wife gets it, and detergents and all that stuff. So I'm kind of set in my ways. And I think that in my mind, it's more of a consumer staple, because women are going to get accustomed to this product. And yeah, maybe the economy goes bad and they're like, no, I'm still going to go to Bath and Body Works because the shampoo that I get there is a little more expensive, but you know what? It's only $2 a bottle more expensive, or $5 or $10, and I only buy it like twice a year. So we're going to go with that. So, all right. So that is Bath and Body Works. It is on the watch list, everybody. So in case you're out there, you're a member, and you'll have access to this. I put it both in the intrinsic value tab and then on the watch list. And FYI, just a quick note. So I wanted to make the intrinsic sheet cleaner. So most stocks I value using a discounted free cash flow model, which you're seeing here, and discounting earnings per share, and then blending the two, where 2/3 of the valuation comes from discounted free cash flows, 1/3 from earnings per share, and then you blend it there. And previous to, let's call it a week ago, I kind of had a mix of some companies were valued this way, and then I had some banks which are different, and we had some REITs. So what I did is I created two tabs, and I made a video this weekend giving everybody that knowledge. So if you are an advanced member and you're looking at the sheet and you're like, whoa, hey, things changed. I can't find Citibank. I can't find UBS. Well, look on the banks tab. And now with banks, I use book value and earnings per share. So I value them correctly. This is how most investors value them. And you can look at what they calculate. Citibank's still 31% discounted. Then you might think to yourself, hey, where'd the REITs go? Well, they have their own tab, because REITs, I use a different method. I first want to know that they could afford their dividend, and then I discount that dividend. It's unique to real estate investment trust. And if you've invested in real estate like I have, you understand that a real estate asset is all about cash flow. It's all about, I'm renting it out for $10,000, all the tenants, all the direct cost are $8,000. I make $2,000 on that property. So it's that type of return calculation. That's what we're doing here on REITs, which we're going to talk about in a little bit, because we wanted to get into some real estate stocks. So just a notice for you advanced members out there that I've separated, and I think it's a positive move forward. And my buddy OpenClaw is helping me update all this data. And let me tell you, it's a saver. It's a time saver, because this is all following the same format. And it goes out to websites like Google, Yahoo Finance, grabs the data, scrapes the screen, brings it back. And it did 162 stocks in like a minute one time. That was cool. That was fun. All right. So let's get back to the stock market. We are trading higher, I believe. Wow, looks a little better, Daryl.
Yep.
You can go for a nice Monday like this. The coffee tastes a little better. Man, I'm going to hit the gym after this. I'm going to hit it with a little more energy. Maybe do an extra couple of push-ups. We'll see how that goes. And overall, we're still about, we're going higher. Not going crazy, but we're going higher. I guess 1 p.m. today, everybody's kind of holding their breath, right? 1 p.m. What's going to come out? What is going to be that event all about? So let's talk a little real estate. So real estate's having a good day. And one thing about stock analysis, guys, they do. So stock analysis I started to use years ago, because the way they lay out their website, I'm a stock investor. I like buying stocks, making money over time, and they give me the cleanest user experience, and I've been using them extensively for, call it, 3 years. I've paid for the pro version. They didn't have a partner program like an YouTube partner program, so I was willing to pay for it. And then they had a program, and they were nice enough to make me a partner and so forth. And if you sign up with stock analysis, please use the code that I have out on my description I get some credit, and I do get a little bit of compensation. But the reason I wanted to kind of share that whole journey is I really like their website, and I'm going to show you one of the things that I really like. So when we look at sectors, and we're going to look at real estate, see how cleanly it just gives me the data I want. It was made for me. I was made for it. And now we've got a list of all these real estate companies. And I know that Daryl is invested in 3 of them, and they're listed on here. Realty Income's one of them. Triple Net's another one. So we could take a look at those to kind of see what's cooking there. And I own CTRE. It's been a fabulous investment. Really glad that I invest in that one. Well Tower, I cover that, and in my opinion, it's not a good investment. It's priced a little too high. But let's take a look at starting with ADC. Let's get into some ADC. Agree Realty. So Agree Realty is a publicly traded real estate investment trust. The firm is rethinking retail through the acquisition development of properties net lease to industry-leading omni-channel retail tenants. Omni-channel being that they sell online and they also sell on premise. So this is a $9.6 billion market cap company, 2.44% rate of appreciation for the year. They pay a 4% dividend. And it's in my book, right? It's not good enough. It did 10%, 10, call it 11, and then this dividend. So I'd like to see a little better appreciation. Dividend's fine. All right. So looking at their growth, wow, they're growing nicely. Why is the stock doing better? That growth looks fantastic. Huh. So we've got earnings look okay. All right. Now, when we go into real estate investment trusts, we need to look for funds from operations. And that funds from operations is what tells us what they're going to pay as a dividend. So we're going to take a look at that in a little bit. Okay, so we got that. We're not going to look at the balance sheet. Usually, real estate investment trusts need to use debt to buy these properties, and then they make money off the income from these properties. So let me kick it over to Daryl, and I'll see if I have Agree Realty in my valuations. If not, I'll create one. Over to you, Daryl.
Okay, there was something that I wanted to add here. So let me go to this chart. The 10-year treasury rate is very important to watch for these REITs. So let me add that for you. So I select price, and what I want to look at is the U.S. Treasury 10-year. And then I want to add a simple moving average, and I want to look at basically 200 days, and I usually color my 200-day moving average red. And then so we can see it pretty close to where the price is, I select it there. And now you can see the U.S. Treasury 10-year rate is right here. And one of the things that you'll see is when they started going up in price here recently, notice that the 10-year treasury was dropping. And when they started their decrease, notice the 10-year started to increase. Now we're starting to, come back down a little bit, and the price has moved back up. So I really like to keep all of my REITs that I own, all of my charts have the 10-year sitting right below it, just so I can keep an eye on that.
And quick question. So if interest rates or the 10-year, if the yield goes down, interest rates go down, what's the impact on real estate?
They have 2 ways of buying new properties. if you look at their shares outstanding, you'll typically see that REITs have an increasing shares outstanding because they can either issue new shares to raise money to buy new properties. They could sell any existing properties that they have. When the 10-year gets low enough, and that's one of the keys there, when it gets low enough to where their cost of capital is lower, then rather than issuing shares, they'll borrow money at the lower rates. So REITs have a little bit of flexibility there on how they expand their business. But one of the things we should look at, either in stock analysis, or I can go to Simply Safe Dividends and look at ADC. So here's Agree Realty. They're trading right at their 5-year average. So a better time to buy would have been up here when that yield was getting pretty high. They have a pretty low beta. So let's go to their shares outstanding. Let's see if this is a good example where we can see the shares outstanding. There you go. Okay, so you can see that they increase their number of shares, and that dilutes any existing shareholders. But some years are lower than others. It all depends on the interest rate. So let's go back to ADC. I own quite a bit of this. I did do a little bit of trimming right up here because I saw those rates were continuing to move a bit higher. So I did a little trimming and have since added back at this lower pricing. Right now, they're currently trading intraday. They shot up above the 20. Last Thursday, they shot up above the 21 and they closed right at the 21. Today, they're intraday, they were above the 21 and now they're sitting right below it. The 50 is also sitting right at that, almost that same exact level. I see a 76.58 on the 21 day and a 76.57 on the 50 day. So they are right at that same level. Now I expected them to actually, I didn't mean to do that. Let's get back to the normal view. I was expecting them to come back down and test the 200, but they started rolling back around, even though the rates were still moving a bit higher, but they have turned down a little bit now, and they're back up to that 50 day. We'll have to keep an eye for any concerns in the bond market, see how that affects the pricing. They're still below the 50 line on the RSI, so that's still bearish territory at the moment. They are moving toward a crossover on the signal line, the red colored line. This is in bearish territory. You can see the difference between the two moving averages are getting smaller by the size of these histogram bars. Distribution really started about the 9th of March and has steadily been increasing, looks to be leveling out a little bit at the moment. Money flow is currently negative. So I don't think they're going to be rushing to an all-time high again. They did back here. They were sitting at all-time highs. I don't think they're going to be rushing back to all-time highs here in the near future, but I like Agree Realty really well. Joey Agree, the CEO, he actually participates in the Seeking Alpha, comments a lot on REITs and what have you. So he's a pretty engaged guy within his investors.
Yeah, and I'm looking. I just completed the valuation on these guys, and It looks like the stock's priced well, tiny discount of 3%. It's it looks like if you want that dividend, looks like a good stock. So there's other what I like to do within really any sector is we buy in a market of stocks. And maybe we can I'm going to copy this guy just so I have the data, and then I'm going to go up to the top of this sheet, because on the top of this sheet I have kind of like where I compare these stocks, right? So here we have some well-known names here. We got, and this has been my ranking last time. It hasn't been updated, I think, on a little bit, but we got Vici up there, CTRE, O is up there. That's looking good, but I don't have ADC in here. So where would ADC be? Like price to funds from operations. So what is that ratio? So 17.8. So they would be kind of like in fourth place. And then when we look at net asset per share, it's 97.13. So that would rank them up here. So that's good. And then price to book is 1.5. So that would rank them up here. So they're a top 4 stock. So if I compare them to the market of stocks that I have in real estate, it's looking like a good investment. If you're going to buy into real estate, you get a choice, right? Nobody's saying, hey, you have to buy this stock or another. And I'm going to pop this guy right in here. Let's kind of move this guy down. It's going to be kind of a wacky format, but that's okay.
By the way, they pay monthly on their
Very good. All right, so this
dividends.
is EDC. Yeah, that's important to some investors that want. And I usually lock this in. Yeah. Oh, no, that's fine. Okay. ADC.
If you wouldn't mind, Victor, scrolling to the right a little bit to get what you're working on out from underneath
our faces are like in the way. There we go.
There you go.
Thanks, Daryl. Okay, so the price to funds from operations 17.8. Net asset value 97.13, and then price to book 1.53. So this one, I mean, I could argue it's either number 3. It's got some numbers that look pretty darn good. This number is the third best. This number is the second best. So that number looks good. I think I got the wrong green there. And this number looks good. So it's got some good numbers there compared to the options we have in real estate. It's looking like a good stock. And then price to funds from operations, it's in fourth place. But you see that it's got a very respectable position. And and you have like some real estate investment trusts that just like the ratios, right? They're just not good. So I try to stay up here. ADC is looking good. So that's ADC. Let's go over to O. O is looking good. O is up here. Price to book is one of the lowest, second lowest. Rank is number 3. The net asset value, not quite as good as ADC, but it's decent. And then the price to FFO is third best. This is a good looking stock as well. And I think they pay monthly, right?
Yes, so their trademark is the monthly payer.
Yeah, they've been that company that I'm familiar with. So that is O Realty Income.
The monthly dividend payer is their slogan.
See, this is a little more like it. 12.4, 5% dividend. Thank you very much. If we have decline in interest rates, these guys will look good. And the forecast for them, let's take a look. So the forecast is that they're going to keep growing. Nice growth, real nice growth. Profits are going to expand. This year is supposed to be a good year for them. Okay. So this looks good. Looks real
One
good.
of the one of the things about REITs is FactSet was expecting them to be the second best performer from a sector point of view this year.
Realty income?
No, real estate in general. But real estate, I mean, they did it in the first 2 months of the year. They were up 20%, and I think the real estate sector was expected to be up 18%. So I don't know what the heck's going on. I don't know if they've already, done their thing in the first 2 months and that they're going to, go kind of sideways from here. I really don't have any good insight to that in the moment because the first 2 months have just been insane.
Yeah. So this one year to date, yeah, 10%. Phew. You want to share the charts on realty income?
Yeah, they look pretty similar to ADC, but I'm adjusting. We haven't looked at this one in a while, so I'm doing a little bit of adjustments on our lines. So they've had a trend line running for a while let me save this. So they've had a trend line. I think that started pretty much at the end of last year, the beginning of this year, actually. And they just traded right above that trend line. They fell out or fell below the trend line during November and December. And then they really shot up here 13%. Okay, so let's go back to 1 year. Pretty similar. The 21 day is actually below the 50, where with ADC, they were almost the exact same value. With realty income, it actually crossed below it on about the 25th of March. And they are trading, it looks like almost exactly similar to ADC, where intraday last Thursday, they went up above and then closed right at the 20. And today they're trading a little bit below, but intraday they were right at that 20. We're getting a little bit of curvature here. So this 21 day, if they can, cross above that, then it would start moving a bit higher. RSI, they're in almost the same exact position as ADC, slightly below the 50 line, so it's considered bearish. We are getting a crossover today on the PPO that is in negative territory. So it looks like the momentum could be moving in their favor. I do see a little bit of accumulation, and the money flow is currently negative. So I've owned real estate for a long time. These REITs, been a pretty heavy investor in them. They pay great dividends. Realty income, ADC are very safe. They have a long-term history in their business. Realty income is also expanding internationally pretty strong. So I like the
Are they
REITs. I
going
have
into
been
Asia? Are they going into Asia?
Europe mostly, I think.
Okay. Okay.
So I've actually reduced my holdings because as I transition to Social Security, I can be a little more aggressive. So I've actually reduced my exposure overall to REITs, but Realty Income is still my number one holding, even though I've reduced it quite a bit. It's still my number one holding at the moment.
It's looking good. I like it's a 23% discount if I value them along the same lines that I showed on Agreed Realty. And it's got good bones. It's got really good metrics. I'm thinking of buying another one. I have CTRE, excellent, and I'm thinking of buying a second real estate stock, and this one's looking good. This one might be a contender. Now, another stock that's come up is Vici.
Yeah.
And Vici, the big picture scares me. What's the big picture? What am I talking about? So, of course, Vici does real estate for mainly casinos, gaming. Their properties are in Las Vegas as well as where they have gaming, like on Native American lands. And it has the best fundamentals, great discount. All those boxes are checked. But why I'm concerned about Vici is we're in a war. I don't know that the spend is going to be there for the consumer. So, for example, I'm in Southern California, Los Angeles. That's the number one source of customers for Las Vegas. Number one. Now, I've driven to Las Vegas 6, maybe 10 times. I fly there as well. But now I'm not a big Vegas guy, but we go there. We have fun. We also have some friends there. And when I drive, boy, there's like a lot of people that drive there. And are people going to want to drive with $6 to $7 per barrel price that we pay in California, per gallon price that we pay in California? I think it's going to make some people stay home. Not everyone, but I think that's going to be lower traffic to Las Vegas. Um, I don't know how resilient gambling is on, if we go into recession or anything. It's not something that I have any like insight into. But the travel space to me is just I'm not feeling convinced that that's going to do well in 2026. I'm actually feeling like that might be one of the spaces that gets hit pretty hard, or I should say, has a bad year. So airlines, hospitality, cruise lines, and Vici doesn't necessarily like they don't run the casinos. They just own the building, they own the land, and the casinos pay them. Okay, and so that's not the issue there. But you can see that the market is is doing this down 9.6%, pays a nice dividend 6.5. Okay, now that's why I'm afraid of Vici. So I'm not going to enter it. I have to buy into the business. I have to buy into the big story. The story I have bought into, and I bought into it a while ago, is CTRE. And I'm glad I bought into this story. 54.5% rate of appreciation, pays a nice dividend. If I add the dividend to this return, I am a happy camper, especially this year, right? What's the story behind Care Trust is Care Trust provides properties where older people that need a little bit of health care can go live. So you had a surgery, you're on the mend, but for the next 3, 6, 12 months, you need nurse attention. That's what they do. Well, our population in the US continues to age, and the population of people over the age of 65 is growing quite quickly. And this particular real estate asset has plenty of demand. So that's why I buy into this story, and I'm not buying into the Vici story. So that's why I invest in this one. I've been in and out of Vici, and right now I'm out. I don't want to go back in for the time being. That's my outlook on those. And this one here has been just a fantastic stock. And I don't want to buy a second one that's in this space. I think is it what's their main competitor? Well Tower is also in the same space, but I like this one because it's smaller, really well run. Their properties are really good. So I'm going to stay in CTRE, and I'm going to pick another real estate stock to start buying into. So we kicked around real estate. Really good conversation. Thank you, sir. Let's get back into what's going on in the stock market. Good chat, everybody. Looks like Vici came up, CTRE. It looks like Alex is making a comment on. So Vici looks interesting. I agree. The numbers on Vici look fantastic. It was ranked number 1 on my spreadsheet. But as stock investing, there's qualitative, the numbers. There's qualitative, which is the quantitative versus qualitative. The qualitative aspects is, looking at the gaming industry. Do I expect that's going to do well, or it's possibly going to do poorly this year? And I'm probably more on it could do poorly. I don't want to get caught, kind of owning something that the surrounding environment is not looking good. That's how I feel about gaming. So I'm going to stay out of it. I'm going to follow my analysis and invest where I think I ought to be going. So that's my intent there. Let's take a peek here of the stock market. Things are still kind of like where we were before. Looks like Oracle's under some pressure. Looks like Tesla's under some pressure. Oh, we didn't talk about Intuit. Geez, what's going on at Intuit? You have time to talk about Intuit?
Yep.
All right. So Intuit's a software stock. We're going to talk about that. And I saw a really good video yesterday on Intuit's AI, agentic AI that's available to QuickBooks users. It looked really good. Of course, the video is kind of produced by Intuit, so you got to be careful. I just stopped working at Oracle last week, and I could tell you that if you go on the Oracle website and you go, oh, here's the agentic AI products that Oracle offers, and they look fantastic. How many of those products does Oracle themselves use? Very little, very little. How many do the customers use? Not much. They're not, obviously, marketing and sales, they kind of paint the picture like, wow, it's fantastic. And then the reality is much lower than what they're promoting. So, but I did see that they have an agentic AI strategy. Now, the whole story on Intuit is, or I should say, why is the stock down 26%? Is agentic AI, like I was telling you about OpenAI. OpenAI is going and updating my spreadsheet. Well, I could do the same thing for your financials. So Intuit is for small businesses. So they have, I'm going to call it 3 categories of products. First, QuickBooks does the accounting for small businesses. TurboTax, tax software. And then the third being MailChimp does email marketing. All 3 categories are going to be impacted by agentic AI. The question will be, can Intuit be can they can they reimagine their product and make it an agentic AI product? And can is the customer base going to come with them as they innovate through that cycle? If the answer is yes, the stock's going to be a winner. If the answer is, well, there's another company that just came out, or a couple of them, and they have a really cool product, and they're peeling away customers from Intuit because a small business owner basically just talks to their accounting system. They never have to type anything. It's like, I'm just kind of creating an example. Intuit's in trouble because when you have that type of competition from an organic new idea like ChatGPT. ChatGPT in 2021 was really nowhere to be seen. Some people knew about it, but only a small fraction of people. ChatGPT in 2023 was the biggest name in technology. Just boom, took off. And the same thing can happen in financials, like financial software. If you have this like open claw or chat GPT event where, oh man, have you seen the XYZ technology that came out of a company we've never heard of? It's like the most heavily used technology for keeping your books. Intuit's in trouble. So there's certainly risk in the market. Early on, I was probably not aware enough. I think it was an error on my part of how real the risk was for software companies. Now, having done more homework research, used the products, gotten very familiar with agentic AI, I'm now realized that, hey, Intuit is in trouble. Oracle is in trouble. Microsoft, they're well diversified. I think they're going to weather it fine, but some of their products are in trouble. ServiceNow, just go down the list. Adobe, there is the gates of their moat, of their castle, are wide open, and the enemy is going to come into your compound, and you're going to have to compete for the new generation of software. You're going to have to put up agentic AI functionality, features, and deliver awesome products because somebody's going to do it. And you better replace your own products or your competitor will gladly do it for you and take away your customers and make your business suffer. So Intuit is, I have a new lens that I'm looking at software businesses with. And their business continues to grow. It's expected to continue to grow 17%. Forecast is going to grow nicely. So the numbers look really good. This is a discounted stock based on the numbers. So what I'm doing is I'm digging deep into Intuit. I'm beginning to examine their strategy around software. What is their agentic? Are people using their agentic AI? Is it real legit? Because I could tell you this is absolutely legit. Cowork from Anthropic is exploding. Cowork, you can go into Intuit with Cowork and it'll do everything for you. It'll go to your bank statements, download your bank statement, put it into QuickBooks, run through all the processes and so forth. You might say, well, isn't that a net positive for the owner of that business that runs QuickBooks? Absolutely. But maybe he had 5 people on QuickBooks. And now all of a sudden he's like, I just need one. Just need one person on QuickBooks because I have Anthropic Cowork. That's great, except now you don't have to pay for 4 licenses. So that's bad for Intuit. The business owner benefited. Great. Small businesses need any help they can get. I'm all for it. But that's where the risk is for these companies. Now, if Intuit does a great job and they say, well, Cowork is cool, but we have this product that's like twice as better, twice as fast, twice as efficient. And voila, here it is. And the customer says, yeah, you're right. Your product is better than Cowork or anything else that's out there. And then Intuit could say, and we want you to pay us more money because we're delivering more money. Perfect. I think the customer is going to be willing to do that because they're like, well, I used to have 10 head count doing accounting, administration of the business. Now we only have 5 because we're so much more efficient. So I'm willing to pay you more money for your software because you're bringing me much more value. That's going to be something we're going to see evolve quickly over the next 2 years. And we're going to see winners and losers in this space. Right now, I'm not buying any more shares of Intuit. I am going to do a lot of homework in software. I just left my software job last week. And I think it's a space where I just want to dig deeper, broader, and I'll continue to make content on it because I think this space here is going to be disrupted in some ways. And if these companies can self disrupt themselves and kind of say, hey, I don't want my competitor to win, I want to win, but it's going to come at a big cost. It's going to be rethink our products. Do not try to sell the same software you were selling 5 years ago because you will be replaced. You have to rethink the whole thing. And if you're slow and lethargic, your competitors will love that because they're going to be fast, agile, and try to grab your customers. So I'm going to show you my valuation. I'm going to kick it over to Daryl. I think we're going to close the live stream after that. So into it. The numbers, these are the numbers. The numbers are much more valuable than the stock price. The free cash flow Intuit is generating is far more valuable than the stock price. It's 59% more valuable. The profits are 37% more valuable than the net present value of those profits in today's time and compared to the stock price. So most definitely the market's like, well, we think Intuit, if they get disrupted, who cares what the numbers look like? This business is going to kind of be, they're going to be at risk of being only a fraction of what they've been in the past. So I have to agree with the market that the market is aware that agentic AI, it really is going to change this industry fundamentally. It's going to be fascinating to follow. I'm going to dig deep and create more content. I created a video this weekend to members covering this topic, and we'll continue to create more content there. Let me kick it over to Daryl. He could tell us what he's seen on Intuit stock.
Okay, so I've been warning about software for a while.
I got to start listening to you, Daryl. I'm going to write that down.
This is a long-term chart. We're looking at 20 years. And look at the performance of software compared to technology beginning in 2019. And I'm not saying you couldn't have made money, but the overall software industry has underperformed technology on a relative
Amazing.
basis.
Good chart. Good chart.
Since 2019. And it began underperforming on an absolute basis starting in December of 2021. Tried to make its way back into positive territory in around the 28th of April. And when I show the Intuit chart here, you'll see the warning that I kind of put out. So let's, this is an interesting chart. Not to say you couldn't have made money. A lot of people did, but it was starting to show some warts as early as 2019. Okay, let's go to Intuit. And I like this company. I've been using their software forever. But back in June of last year, when they were seeing increased prices, I noticed this bearish negative divergence, and you guys probably get tired of hearing me talk about those. But just look at what happened to the price. Once it finally kicked in, look what's happened to the price. That's why I spend so much time looking for these on my own charts or charts that I share here, because people get, exuberant. Things are going to the moon, but underneath the surface, you start seeing some warning signals. And it may take months. In the case of Google, it did take about 6 months for it to really kick in. This one was only a couple of months. So anyway, we do have a declining 200 day. We have a couple auto support resistance line. It did bounce off that price, which is 359, bounced off of it. We had more than 3 white soldiers here. We had a bunch of them. I'm sure people were jumping on the boat like crazy. And then it started on its decline again. We have a 50-day that's declining, the 21-day that's declining, and they've been trading sideways for pretty much 2 weeks. So people are discounting their terminal values on most of these software companies a lot more than they were prior. So that is affecting the valuations. The chance to get back to an $800 level, I think, is less than 5%, less than 1%. I don't think they'll see that again for many years. So anyway, that's my feeling. I haven't owned many software stocks, and I spent my entire career in software. It's not like I'm blind to it. So I used to write software for a living. That was my job. So
Interesting. Well, excellent analysis, and let's keep watching it because I think, if anything, it's super interesting to see an industry really change. And man, it is changing fast. It's pretty incredible, breathtaking. All right, so let's kind of begin to land the plane, and looks like the market is pretty much where it's at. And what's happening with my channel this week? I'm going to try to live stream tomorrow, and tomorrow, what I hope to do is probably stream for the last hour of trading and maybe an extra hour after that. And join me if you can. I'll try to post the live stream details when I can. And if Daryl's up for it, we'd like to stream on Wednesday, same time, starting at 10 a.m. Eastern. And then we'll go for a couple hours. I really like having the market open. We're seeing what we're dealing with. And I could just, talk about a stock using the pre-market or right when the market opens. There's like a lot of noise coming at me. So I think I could do better work if the market's fully opened. So Wednesday and then Friday, I think we're going to be streaming. There's not a lot of big earnings announcements this week. We have Delta announcing on Wednesday. That'll be interesting for the travel industry. And next week, I think we're beginning to see some interesting earnings reports. And then in 2 weeks, it's going to be active. We'll do a lot of watch parties where possible. Those were really fun. I think a lot of people like those. But other than that, I'm going to be creating some more videos for members of my channel. If you want to see my content real time when I produce it, become a member. You could get the information on my YouTube channel, and there's a couple levels. Depending on the level that you choose, you get different access. And I put a lot of time and energy into it, and I really appreciate everybody that's already a paid member. Consider being a member if you want to see my content real time. And then I release the content like 30 days later in some cases. Some content always stays on members only. So we'll see what happens. And looks like Shadow Guy has made an appearance. Yeah, the U.S. market was open today. Oops. So that's what's going on with my channel. Daryl, what's going on with your channel?
I put out my weekly chart review and a market summary. I also looked at seasonality of the SPY for midterm election years. That was kind of interesting and enlightening for my point of view. Then I also did a pretty detailed review on United Health and why I'm starting to re-enter that particular holding. So anyway, those are two that I put out over the weekend. If you're not a member of my channel, you can scan that QR code or just go directly to my handle here at Investing Portfolio Pathway on YouTube.
Excellent. Please do so, everybody. Please subscribe to his channel. I know Daryl puts a lot of time and energy into the research he provides, and it's super valuable. So I really appreciate it. All right, that's it, folks. We will end it there. You guys have a terrific week. It looks like we're off on a green start, but boy, things could change when our president speaks at 10 a.m. Pacific, 1 p.m. Eastern. It's going to be about an hour. We'll see what market we have. Knowing that that's going to happen, I'm not going to trade a whole lot this morning.
No.
I'm going to wait to see what are we dealing with, and then we'll see what we got. So that was a really cool stream. Thanks so much, Daryl. Great work today.
Thank you, Victor. It was good to be here.
And I'm going to reiterate my commitment to listen to you when you talk about software stocks. But let me tell you, sometimes I have to pay for lessons, and sometimes I'm a quick study. And boy, on software stocks, I'm paying like private college level tuition for that lesson, but I'm going to try to learn from it so I can get better. Overall, I'm a successful investor, but I want to keep getting better. I'm only going to get better if I'm humble and I keep learning. And I really appreciate learning from Daryl, learning from everybody. I watch other YouTubers, I study, and I'm going to continue to try to get better. So that's it, folks. Awesome stream. I look forward to seeing your names on the next one. And I really appreciate how many people attended. Thank you so much. And great to see everybody on the chat. Take care.
Take care, everyone.